When you had to split something as a kid, that generally didn't feel like a perk. But when you're an investor, splitting can be a good thing. A stock split is a tactic for making a stock more attainable to smaller investors, particularly when its price has ratcheted sky high over time. One recent example. On July 30th, Apple announced a 4-for-1 stock split in a bid to bring its share price back to around $100. While neither the company's value nor that of your investment changes in a split, it's important to understand how stock splits can impact your portfolio. Here's what you need to know. What is a stock split? Stock splits are a way a company's board of directors can increase the number of shares outstanding while lowering the share price. Stock splits are accompanied by somewhat confusing arithmetic, such as 2-for-1 or 3-for-2. As with many things in life, pizza can help. Imagine a company's value represented by an entire pizza. When its stock trading began, that pizza was sliced into a finite number of pieces or shares that were offered to investors. For simplicity's sake, let's say the pizza was divided into 8 slices and you owned 1 share. If a company announces a 2-for-1 split, the number of shares doubles, so the original pie will be divvied up into 16 slices. Whereas you owned 1/8 of the company before, as a result of the split, you'll now own 2/16. Same amount of pizza, just a different number of slices. That same principle is applied no matter what the split ratio is. The last stock split from Apple, for instance, was a 7-for-1 in 2014. There is also such a thing as a reverse stock split. As the name suggests, this kind of split goes the opposite way. The number of shares is reduced, but the price per share increases. This is often done to meet the minimum stock price required for a company to be listed on an exchange. What happens when a stock splits? A stock split doesn't make investors rich. In fact, the company's market capitalization, equal to shares outstanding multiplied by the price per share, isn't affected by a stock split. If the number of shares increases, the share price will decrease by a proportional amount. If a stock traded at $100 previously, it will trade at $50 after a 2-for-1 split. Yes, you own more shares, but they're each worth less. It's basically a draw, and the value of your investment won't change. However, investors generally react positively to stock splits, partly because these announcements signal that a company's board wants to attract investors by making the price more affordable and increasing the number of shares available. As a result, your portfolio could see a handsome benefit if the stock continues to appreciate. Studies show that stocks that have split have gone on to outpace the broader market in the year following the split and subsequent few years. How to take advantage of a stock split. You need to be a shareholder by a certain date, specified by the company, to qualify for a split. If you're not yet an investor in a company and a stock split has made its share price more affordable, you'll want to research the stock to ensure it's a good investment for your portfolio before you buy. Pros and cons of stock splits. Improves liquidity. If a stock's price rises into the hundreds of dollars per share, it tends to reduce the stock's trading volume. Increasing the number of outstanding shares at a lower per share price adds liquidity. This increased liquidity tends to narrow the spread between the bid and asking prices, enabling investors to get better prices when they trade. Makes portfolio rebalancing simpler. When each share price is lower, portfolio managers find it easier to sell shares in order to buy new ones. Each trade involves a smaller percentage of the portfolio. Makes selling put options cheaper. Selling a put option can be very expensive for stocks trading at a high price. You may know that a put option gives the buyer the right to sell 100 shares of stock, referred to as a lot, at an agreed-upon price. The seller of the put must be prepared to purchase that stock lot. If a stock is trading at $1,000 a share, the put seller has to have $100,000 in cash on hand to fulfill their obligation. If a stock is trading at $20 a share, they have to have a more reasonable $2,000. Often increases share price. Perhaps the most compelling reason for a company to split its stock is that it tends to boost share prices. A NASDAQ study that analyzed stock splits by large-cap companies from 2012 to 2018 found that simply announcing a stock split increased the share price by an average of 2.5%. In addition, a stock that had split outperformed the market by an average of 4.8% over 1 year. In addition, research by Dr. David Eikenberry, a professor of finance at the University of Colorado's Leeds School of Business, indicated price performance of stocks that had split outperformed the market by an average of 8% over 1 year and by an average of 12% over 3 years. Eikenberry's papers were published in 1996 and 2003, and each one analyzed the performance of more than 1,000 stocks. An analysis by Tak Yan Leung of the City University of Hong Kong, Oliver M. Rui of China Europe International Business School, and Stephen Xu Wang of Renmin University of China looked at companies listed in Hong Kong and also found price appreciation post-split. Could increase volatility. Stock splits could increase volatility in the market because of the new share price. More investors may decide to purchase the stock now that it is more affordable, and that could increase the volatility of the stock. Many inexperienced investors mistakenly believe stock splits are a good thing because they tend to mistake correlation and causation. When a company is doing really well, a stock split is almost always inevitable as the book value and dividends grow. If a person sees or hears about this pattern frequently enough, the two may become associated. Not all stock splits increase share price. Some stock splits occur when a company is in danger of having its stock delisted. This is known as reverse stock splits. While investors may see the per-share price go up after the reverse split, the stock may not grow in worth after the split, or it may take a while for it to recover. Novice investors who don't know the difference could end up losing money in the market. Have you ever owned a stock during its split? If so, which one? Let us know in the comments below. Thank you for watching. Don't forget to leave a like and subscribe if you're new here. And until next time, keep up the hustle.